So we have a distinguished panel tonight, way outstripping your host. Joining me, Randal Quarles, former Federal Reserve Vice Chair, founder and CEO of Sinosure Group, and Professor William Silber, Senior Advisor at Cornerstone Research, and former Marcus Nadler, Professor of Finance and Economics at NYU's Stern School of Business, and author of The Power of Nothing to Lose, The Hail Mary Effect in Politics, War, and Business. Nadler, right? That's how to pronounce that.
Marcus Nadler.
Marcus Nadler,
sure.
Of course, a famous guy.
He was.
Gentlemen, thank you very much for coming on the show. Randy Quarles, let me start with you. Does this banking crisis, I'm not even sure, it was a banking problem. It may be contained, it may not be contained. I hope it is contained. Do we need more regulations as the Biden policymakers are suggesting?
Well, I don't think we need significant new regulations. I don't think that regulation was really at the heart of what happened with Silicon Valley Bank. It was a question of bank mismanagement. And when you look at the issues there, the regulatory framework that applies to the biggest banks in the country would not really have changed the outcome at Silicon Valley Bank.
How is it that Michael Barr, I'm going to go to you, Professor. Michael Barr, so he has Randy's job now, right? It's basically the same job, Vice Chair for Regulation and Supervision, whatever it's called. It's an important job, it's a big job. So he goes up there, Barr and other representatives, and they talk about the dumb management, which is true, okay. And they talk about the need for more regulations, which Randy Quarles thinks is not true. But you know what? They forgot to talk about the Federal Reserve's role about pumping up the money supply and creating higher inflation, which drove up interest rates, which devalued all the bond assets, you know, the duration and interest rate problem. Why did they pass the buck like that? Is this institutionally what the Fed has to do, always does? Don't you get sick of it?
Well, I'm going to bring it down to something even more, even a narrower issue. And that is when Silicon Valley Bank ran into this problem, they didn't have enough capital to make the payments to their depositors. Well, there's a Federal Reserve discount window.
Right.
The discount window is open to any bank that needs it, and in fact, they can lend on any collateral at any price that they want.
That they so choose.
Which they do.
Mm-hmm.
Except they didn't at this point. And I've not heard a single explanation for why the Federal Reserve's discount window was not used to help Silicon Valley Bank make payments, since, after all, they're doing the same thing right now by giving out collateral at 100 cents on the dollar on bonds that are only worth 80 or 85.
Why didn't they, Randy? I mean, this is ground worth going over again. Why didn't they?
So I don't know. Obviously, it's the reason that the Federal Reserve exists, to provide that sort of liquidity when banks come under that sort of stress, precisely so they don't need to fail. I suspect, though, that the concern was simply the scale of the run. So much was leaving the bank so quickly at a pace that was historically unprecedented, that they feared that even sort of standing up and saying the Federal Reserve has all the money this bank will need would not really address what had become a relatively irrational stampede. That's my hypothesis.
I'm just saying, I mean, making a point, it's not the only point, but making a point that one of the root causes of this whole business was monetary policy. Now, I'm going to add fiscal policy, excessive spending. Absolutely. The two of them worked hand in hand, overly stimulative in 2021 and most of 2022 before they buckled down. But I'm just going to say these guys go up to the Hill and they all testify before committee people, senators, House members, and so forth. And they try, they say, well, not us, it's them. And then the solution to them is more regulations, which you call is so nonsensical, it isn't even wrong. Which I love, by the way. It's a great turn of the phrase. So, why did they do that? Why do they do that?
Well, I would...
And to be constructive, okay.
Yeah.
What should they do now? Instead of they're talking about here, more capital ratio, higher capital ratios, higher deposit liquidity ratios. Really? Is that what they need?
Well, certainly no amount of capital is going to protect a bank that's subject to an overwhelming bank run. I mean, no bank can survive a bank run unless it's just a piggy bank with nothing, that just has money in order to pay out for deposits. So capital is not really the answer to the issues here. I think you do have to think through, why did the uninsured deposits in this bank behave differently than depositors have generally behaved over the history of banking? This was a extremely rapid run, and from core depositors of the bank, which experience would tell us uninsured depositors are more likely to run than insured depositors, but they're still depositors. They generally don't race away from a bank, and certainly not at the scale that we saw here. So does it have something to do with the nature of these depositors, their concentration in a particular industry, or does it have something to do with the nature of all depositors today because of modern communications methods and social media, and all of us see every rumor on our Twitter and can immediately act on it? And does that mean that you need to rethink how depositors in general will behave? But it's not a question, that's mostly a question of supervision and not a question of putting more regulations on banks.
I don't really think free speech had much to do with this. Get right down to it. Professor Bill Silber, I want to ask you about a friend of mine, Bill Isaacs, talks about in an op-ed piece for the Wall Street Journal an 80% solution for uninsured deposits that was put into place for a time in the early 1980s. I mean, is 80% really better than 100% for uninsured deposits, or what do you think about that?
Well, I read that op-ed.
And he's a smart guy, and he's a good guy.
He is a very smart guy. So after I read that op-ed, I went back to the monetary economist's Bible that you know, and that is Milton Friedman.
And this is coming.
Well, of course. Well, why shouldn't it come? It belongs right here.
No, this is good.
So Milton Friedman and Anna Schwartz, A Monetary History of the United States, and they say the single most important structural change that came out of the Great Depression for the banking industry was deposit insurance. And they say, they talk about deposit insurance, and they are clear that is only $2,500, $5,000, $10,000. But there's a sentence there which says, but de facto, there has been 100%.
Unlimited.
Unlimited.
To get to your earlier point.
That's correct. And they don't denigrate that. 100% deposit insurance, sounds like, well, where are the banks going to be disciplined? And I say, go to the other side of the balance sheet. I want you to discipline bank management. I want you to discipline the bondholders, and I want you to discipline the stockholders by not allowing them to have, downside protection.
Right.
Don't give them a free pass.
That's your Hail Mary point.
That's correct.
It's a great
point.
Don't give
them a free pass.
Absolutely.
on those assets.
That's the problem I have with the Isaacs hypothesis also, and still do. Randy, are we through this? Are we through this so-called banking crisis? Because there are lists of banks out there that are still threatened by duration risk, bond risk and so forth.
I think we should be. I think that we're seeing the pressures abate on the system. And I think it's logical that we should be, given the measures that the government has taken. Whether it's right or wrong, they have effectively insured all deposits at this point, given the actions that they took on the Sunday after Silicon Valley.
And he says that's a real bad idea, and it's going to cause moral hazard, and we're going to bring out the worst in bankers, climate change, woke, God knows what. It was a rogue bank out there to begin with. Really? Think about that for a minute.
I would worry about that. I think I see the logic of insuring all deposits more than I would have 2 weeks ago, but I still think that there are better solutions. And I'd focus on trying to create incentives for the institution itself to limit the amount of large, concentrated, uninsured deposits that it has. So there are appropriate responses to this. I'm not saying that the government should do nothing and learn no lessons. It's just that the lesson is not, let's take the most costly and unfocused regulation possible and apply that farther and farther down in the system. Let's focus on the real issue.
I would just add one lesson. We're running out of time. Akil wants to get rid of all of us. One lesson here is the supervisor should supervise. I mean, the Fed's trying to walk around that too. You know, they pegged and flagged the problems. They just didn't do anything about it. I mean, they can be mean and tough and cruel when they want to be, and they weren't. But that's a different segment and has to do with, shall we say, there's where your social media, social policies come into play, Lord knows. Anyway, Randy Quarles, William Silber, thank you very much.